Good morning and welcome to my world. I'm Kenny Polcari, your host of the party, and today is Thursday, June 6, 2024, and here are the things that you need to know. Besides the fact that it's nice and beautiful and warm out, here are the things you need to know. The S&P makes a new high, the 23rd in 2024. Nvidia continues to stun investors, becoming now a $3 trillion company. The split happens tomorrow after the bell, taking place for trading on Monday, right? We'll be ready for Monday. It'll be a $120 stock or $112 stock. Economic data continues to suggest weakness this week. The NFP comes out tomorrow, so sit and wait on that. Bonds have rallied by 5% over just the past 4 days on this news. Gold is up, oil is struggling, and the dollar is down. And what do we have for dinner tonight? Well, try this. The rigatoni con crema di zucchini e burrata. Sounds delicious, doesn't it? Okay, we're going to get to that in a moment. All right, sports fans, here we go. On Monday, if you remember, I said this, and I quote, the S&P closed at 52.77, up 42 points, leaving us just 53 points away from the May 23rd high, around 53-ish 40. And with the ongoing rate cut narrative alive and well, and more positive news out of Nvidia that's affecting nearly any industry that uses tech, which, by the way, is all of them, I suspect that we were going to try and kiss and test 53.40 today, which was Monday, which is just up 53 points or 1.1% from where we were. Futures are already up 10, so what's another 40 points amongst friends, right? That was on Monday. So I was a couple of days early. You see, they are keeping this rate cut narrative story very much alive, and Nvidia continues to impress, right? Yesterday it was up 5.2% or $60 a share to end the day at 1,224, becoming a $3 trillion market cap company, surpassing Apple in that space. Apple's now in the third place. Microsoft's in first place. Just FYI, Nvidia's up 31% since they announced their earnings and the stock split and the new chips on a rolling 12-month basis 2 weeks ago. It's now up 147% year to date. It's just amazing. Yesterday, the S&P teased, kissed, and pierced that May 23rd high to end the day up 63 points or 1.2% to score another record of 53.54. The other indexes all basking in the sun. The Dow Industrials rose 96 points, the NASDAQ goes up 330 points, or 2 full percent. The Russell added 30 points, 1.5%. The Dow Transport's up 176 points, up 1.2%. The equal-weighted S&P up 41 points, or 0.6%. Now, just 24 hours ago, we got another data point, the fourth one this week, and we learned that the ADP employment change rose by 152,000 new jobs, 25,000 fewer jobs than estimated. In addition, the prior month's read was also revised lower, right? That's a negative. And this followed the Tuesday JOLTS report that showed 300,000 fewer job openings. And this followed Monday's manufacturing PMIs for both the S&P and the ISM that declined well into contractionary territory. And this comes just hours ahead of tomorrow's non-farm payroll report, which is expected to show 185,000 new jobs and a 3.9% unemployment rate. So don't get up from your chair just yet. Order breakfast and lunch in and stay tuned. On the other hand, though, yesterday, we got the S&P Services PMIs and the ISM Services PMI, right? And both coming in strong. S&P came in at 54.8, ISM came in at 53.8, well into expansionary territory. Remember, 50 is a dividing line. And since we're a 75% services economy, this is an important number, and it speaks to the cost of services, which continue to go up, and so they're too damn high. If the NFP report tomorrow surprises to the downside and the unemployment rate suddenly goes to a 4 handle, then watch out how much faster this rate cut narrative story is going to gain momentum. Clearly, if it comes in hotter, then it's going to throw that whole story into chaos. But again, be careful what you wish for, because remember this, cutting rates because they slayed inflation while keeping the economy firing on all 8 cylinders is very different than cutting rates because the economy is about to go over the edge and banks are about to fail and unemployment is rising above 4%, all while inflation remains hot. That is not the same bullish story at all. Now, for those of you who never experienced it, it's called stagflation, and that is not a pretty place to be. Stagflation is defined by high inflation, high unemployment, and stagnant economic growth. The combination of these factors creates a very big problem, economic challenge for policymakers and for everyday Americans who have to deal with that kind of economic environment. The last time this happened was 1978-ish, 81. It was during and at the end of the Carter administration into the Reagan administration, right? He inherited it. So it's been a while. It's been like 44 years or so since we've had experienced this kind of stagflation. So the odds are rising that it just might be time. I mean, I don't want to see it, but let's be honest. The odds seem to be favoring that outcome. And we're going to find out more tomorrow and then again next week when we get the other data in the FOMC. Today it's going to get a few more data points. First of the usual suspects, initial jobless claims of 220,000 unchanged, continuing claims 1.79 million unchanged, and then revisions to the trade balance, which is a non-event for you. The two that I think are going to be most important today for us as investors includes unit labor costs, and that's expected to be up 4.9%, up from 4.7% last month, suggesting inflation remains sticky. And the Challenger job cuts report year over year. This data point tracks the number of announced job cuts in the U.S. It provides insight into the labor market by focusing on the reasons for those cuts, which range from anywhere from a weakening economic conditions to restructurings or mergers that created duplicate jobs. It captures the planned layoffs, not the number of people let go. If we get a positive number, then that's a signal of distress in the economy because it suggests an increase in planned cuts, while a negative number would indicate stability, right? Because it represents a decrease in planned cuts. Last month, the number came in at negative 3.3%, and that was considered bullish. Gaish? Now, bonds have been loving this weak news this week, right? A weakening economy has to mean lower rates. And so we saw the TLT yesterday gain 0.7, the TLH was up 0.6, and the AG was up 0.3. And this sent the 2-year yield down to 4.72%, the 10-year down to 4.27. Shorter duration bills like the 3 and 6 month are yielding 5.24 and 5.14% respectively on an annualized basis. Now, for those of you wondering, because bonds have been under pressure all year, the TLT is up 5.3%, the TLH is up 4.3%, while the AG is up 1.9% in just the last 4 trading days. And while they are still negative on the year, they're just a little bit less so. Swaps traders are now fully pricing in 2 rate cuts in 2024. See how this changes? One in November and now the other in December. But they're still building wave of support for the Fed to cut sooner. And while next week is most likely not happening, July appears to be getting some interest, right? Appears to be getting hot. And while they could consider September, I caution you, 6 weeks ahead of the presidential election, really? Think about that for a minute. I also think that July is too risky as well. But look, that's me. They're going to end up doing what they want to do. I just don't think it's appropriate. I expect everyone to pay very close attention to what and how JJ speaks at the presser next week at 2:30 on Wednesday. And no matter what he says, remember, people hear what they want to hear versus what's being said, right? And there lies the rub. Now, I was on the Big Money Show yesterday, and we discussed this very point, along with the new challenge to the New York Stock Exchange. It's a Dallas-based exchange funded by Citadel and BlackRock, and it's going to be called the TXSE. You can find that on my Twitter, right, at Kenny Polcari. I posted it early this morning. Now, oil, which has been a nightmare of late, as it considers an economic downturn on the top of planned increases by OPEC Plus in October, it bounced a little bit yesterday off the Tuesday lows of 72.48 and is now trading at 74.75. Analysts pointing to a short-term oversold condition, saying that oil traders maybe went too far too fast. The RSI, the relative strength for oil, suggesting that it was approaching that oversold territory. So we got a technical bounce. I think oil remains in the $70, $80 trading range now until we get more economic clarity, and I do think that they do want to test 70 to see if the buyers are there at some point. Not today, maybe, but over the next week or so. Gold, as expected, surged higher yesterday on the news of a weaker economy. It was up $28 to end the day at $23.75. Now, we've talked about this, right? Lower rates are going to weaken the dollar, and that's going to support gold and other precious metals. This morning, gold is up another $7 at $23.82, leaving us in that $2,300, $2,400 trading range, a range that I've been talking about for weeks now. U.S. futures are digesting the move up yesterday as they consider the implications of lower rates. Dow futures were down 36, S&P's up 1, Nasdaq up 28, the Russell's down 3. Now, we are swiftly approaching the end of the second quarter, and by all accounts, it hasn't been a bad year so far, right? Now, July marks the second half of the year, the beginning of the third quarter and the second half of the year. Goldman is coming out now telling us that they expect a wall of money to pour into the market in July, which sets us up for a continued rally. Scotty Rubner, who is Goldman's Global Markets Division Managing Director and Tactical Strategist, tells their clients that the new quarter and a new half of the year, and that this is when the money comes into the market quickly. He points out that since 1928, the first 15 days of July have been the best 2-week trading period of the year for equities, bar none. He also notes that the S&P 500 has been positive for 9 straight Julys, posting a return of 3.7%, while the Nasdaq has performed even better, up 16 straight Julys, posting an average gain of 4.6%. Now, in Europe, markets, they're on the edge. Yes, they're higher, tech leading the charge, but investors there are awaiting the ECB decision, which came out already. And in fact, I correct myself because I thought it was coming out yesterday, and I said that, but that was just my mistake as I had my days mixed up. It came out today. In fact, everyone's now expecting Madame Lagarde to announce a 25 basis point rate cut, which she did. And why? Because this is what they have promised, right? This is what they have prepared the markets for. Numerous ECB members have all but guaranteed it. So if they choose not to cut, you better watch out below. But they did not. They did cut, so things are okay. And since that's something they don't want to see, they didn't want to see the market collapse. I, like everyone else, expected a rate cut, and we got it. But she also laid out that she's suggesting more cuts to come in the months ahead. How many? Will the latest uptick in the Eurozone inflation change her mind, change the narrative? The smart money says that this is the start of a 150-point basis cut that's going to take the ECB through 2025, right? At 5 o'clock this morning, we saw Germany was up 1%, the UK carrying up the rear, up 0.25%. This move follows the Bank of Canada, right? Their decision yesterday to cut rates by 25 basis points. They went from 5% to 4.75%, while indicating that there is more to come. This makes Canada the leader of the pack. They are the first of 7 central banks to kick off the easing cycle: the Fed, the ECB, the Bank of England, the Bank of Japan, Swiss National Bank, the Bank of Canada, and the Reserve Bank of Australia. The S&P closed yesterday at 53.54, up 63 points, closing in on the new high, which usually means new highs beget new highs, and so we wait. Now, technology is still driving this move up. Nvidia is just $100 billion away from taking over Microsoft as the most valuable stock in the U.S. And while that seems like a lot of money, it's only $100 billion. So be careful. The market is being driven by this handful of tech names. We've known that, we've talked about it, and we know how quickly that can all change, right? Especially if we think the market, the economy is going to start to flounder. Be prudent with your money. Understand the risks of overweighting in a sector. If you're in the 20 to 50 range, maybe a bit less so, but if you're in the 50 plus range, you just need to get comfortable with being a bit uncomfortable. And if you're not, then you probably got too much at risk in one sector. So make sure you understand that. Remember, the data this week, coupled with the CPI, PPI, and the FOMC announcement next week, can and most likely will create some volatility. The S&P and the Nasdaq are kissing the 70 line on the RSI chart, which just means that tech being the driver here. So don't chase it, right? They're getting into an overbought condition, and that usually suggests that a pullback is near. The Russell, the Dow, and the equal-weighted S&P are not near the overbought line, which just means that there are opportunities out there. Again, while we're not knocking on death's door, evidence is building that the economy is starting to slow. Whether we get to death's door is still up for debate, which is why so many continue to scream for a rate cut. Because they think the rate cut is going to save everything, right? So call me to discuss this long-term game plan, right? I love to help you create long-term wealth and generational wealth. So give me a call because I'm always happy to talk about it. Okay, so what do we have for dinner tonight? So this is really delicious. I'm going to make this tonight and then I'll post the picture. I said it to you in Italian because it sounds so much more dramatic in Italian, right? Rigatoni con crema di zucchini e burrata, right? I mean, it sounds, just the sound of it is delicious, right? It gives me tingles down my spine. And what it really is rigatoni with zucchini, basically zucchini pesto and sliced burrata cheese. Okay, it is so good. Now for this you need 3 or 4 zucchini depending on the size. You need garlic, olive oil, rigatoni. You need the burrata, fresh burrata. You need salt and pepper, chicken stock, and freshly grated Parmigiana cheese, lemon zest, and a little bit of mint. You want to begin by bringing that pot of salted water to a rolling boil. Set it on the back burner just so it's ready for you when you need it. You're not wasting more time heating up the water. Then once it boils, just turn it down to simmer and keep it there. Now in a large saute pan, you're going to add some olive oil and 2 cloves of sliced garlic. Saute it around. Then you're going to add in 2 of the zucchinis, which you've kind of sliced and diced up. Don't make them big, just kind of make them small, because you're gonna puree these anyway. Season it with salt and pepper. Add 2 or 3 mint leaves. Right. After about 5 minutes, you're going to add a half a cup of chicken stock, and then let it cook for another 5 or 8 minutes. Right, until it gets nice. The zucchini will get soft, and the chicken stock is mostly evaporated. Right. Then place it in a food processor and blend it. Right, you want to blend it well. You can add a handful here of a grated Parmigiana cheese if you want. I always do. You don't have to, but I always do. Now, take the other zucchini that you have not used yet. Now you want to slice that into rounds, not really thick, kind of thin rounds. You're going to fry them in that same saute pan with more olive oil, season with salt and pepper. And when they're all nice and browned on both sides, just remove them and set them aside. Now, add the pasta to the water, cook until it's al dente, 8 minutes or so. Strain the pasta, always reserving a mugful or 2 of the pasta water, otherwise known as the tears of the gods. Add the pasta to the saute pan, add the zucchini cream, the pesto that you just made, and add a little bit of the pasta water. Stir it to coat it really well. When serving now, place the rigatoni in the bowl, top it with a bit of lemon zest and some of the fried zucchini. Finish by slicing the burrata into quarters and then place 1 piece on top of the warm rigatoni. It is delicious. It is delicious. I'm going to make it tonight. I'm going to take a picture. I'm going to put it out there on my Twitter so you can all see it. Until tomorrow, take good care.